Can the Fed still spook the stock markets? Halloween joke, ha ha ha. Or are we now out of the window for them to do so since rate hikes appear to have ended? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we're going to see what is on the menu here for tomorrow's Fed policy announcement and consider why it might be that we're actually not out of the woods and why the Fed might still be in a position to hurt financial markets with its various prognosticating. So let's consider here, first and foremost, what it is that is on the menu, and then consider why this might be bad news yet for stock markets. And perhaps a bit of a nuance here that actually tells us where opportunities might lie, if not in those markets that are going to be on the receiving end of any turmoil. So first and foremost, expectations. The general sense here, clearly, that the Fed is done raising rates. So what we're looking at here, then, is a situation where the probability of another increase at this meeting is a big 0%, as it is priced into Fed funds futures. The more interesting bit is that we still have a slight possibility for tightening, a 27% chance of a rise being implied for the December 13th meeting, a further 13.4% chance being implied for the January meeting. So when we add those together, the 27 and the 13, we get a cumulative probability of a 40.5% that there is a hike by January. Now, obviously, that is less than 50%, so the markets are very much leaning in the direction of saying that the Fed is done here. As we can see, from then on, the focus starts to shift in the direction of rate cuts. So we have a 55% chance of a cut by June, and then it is fully priced in, that cut, by July. We have a total of 2 cuts already in the forecast for 2024, so the markets have already adjusted for that. And by January, a third. So if we think about this easing cycle going forward, we're looking at about 0.75% or 75 basis points, considering the average rate move here that you see in the far right column here is 25 basis points or 0.25%. We have 3 of them that are on the menu here, basically by January or by the end of January. That January meeting scheduled for the 29th. So once we get through January, the baseline is 75 basis points will have come off benchmark interest rates, and we will be hovering somewhere in the 4.75 to 4.5 range on rates. Interestingly, this has not moved very much since the Fed met in September. So we can see a little bit of what's going on here. So we can see the rates now held at 5.38. That's, of course, the midpoint. The Fed sets its rates in a range. So we're looking at 5.25% to 5.5%. The middle of that is 5.38. We can see that persists here. We remain essentially below 5.5, which would imply no more rate hikes for the next 6 months. From there, the easing starts. And what you see here immediately is, in the wake of the Fed's September 20th announcement, the curve has become a bit more shallow here. So over the course of 6 months to a year, a little bit more dovish. And then over here, once you get to the 2-year mark and thereafter, is that higher for longer narrative. So the long end of the curve, we can see, has actually shifted higher. since the Fed met. The big dots here, the September FOMC setting. Since then, we can see the market envisions a bit more economic weakness in the near term. So here we are. The path is a little bit more aggressive toward what the easing looks like after this extended hold. And then rates settle higher and remain higher at the longer end. So that's the baseline. And looking at this, one would think, well, nothing has really changed very much since this meeting. These are all relatively modest adjustments. Surely the markets have priced everything in. Well, if you thought that, then the price action since the FOMC meeting in September will have surprised you, because the markets were anything but sanguine. There is the general dynamic here from about the mid-year. So we can see that once we got out of the window where the focus of conversation was the debt crisis that popped off with SVB and the shakeout of the tech-sensitive regional banks, thereafter went directly into another bit of concern around the debt ceiling. And then right around May, June, things seemed to settle. Now, of course, rate cut expectations jumped around those things, with the markets expecting that the Fed might have to do some serious firefighting if either of those things go terribly wrong, but neither of them did at the time. And so those rate cuts that the markets were expecting to imminently occur started to fade. So what we see here in the gray bars is that fading. So we're looking at June and we're seeing the markets were expecting about 2%, 1.75%, something like this, in cumulative rate cuts between this coming meeting, November, and the end of next year, December 2024. We can see those bars are getting shallower and shallower into negative territory. And as that happens, the market becomes more and more worried that borrowing costs will be higher and stocks go down. So just as you get a bottom on rate cuts, as it were, so you get the most negative readings start to recede and become less negative, so fewer cuts, stocks get more and more worried that borrowing costs are going to be higher, so financing earnings, financing economic growth, and frankly, financing any kind of economic activity, you name it, from consumption to investment to government spending to anything under the sun, becomes more expensive. Needless to say, stocks don't like this, and so they come down. We point out here the saga as it's evolved since the September 20th FOMC. There it is. You can see that marked a key reversal. So if this were some kind of a range where this were a bottom, we can see clearly we begin the next leg of the trend lower right here as we break underneath whatever was holding us up right here and extend downward. And you can see the key catalyst for that was the September 20th FOMC. Now, what happened at this FOMC? Well, the Fed came out and basically said, look, we're not going to raise rates, but we're going to hold them higher for longer. And to define what that means, here's an updated set of economic forecasts. The Fed does this once a quarter. And the bit in the forecast that has the Fed policymakers' expectation for where rates are going was 50 basis points higher for next year's forecast than it was when they looked at it the previous time in June. In other words, the Fed said, we're going to do 0.5% more in tightening, or we expect we'll have to do 0.5% more in tightening. Now, that doesn't necessarily mean more rate hikes, but it does mean that rates will be held 50 basis points higher than they thought in June. In other words, the cuts will be fewer and they will come later. Needless to say, not a happy thought for markets. We can see now over the period from this meeting to the end of next year, the expectation is for about 75 basis points in rate cuts. That's this right here. So what we're looking at now is an outlook that is just about 100 to 125 basis points less dovish than it was at mid-year. And then we see how the market has been responding to news flow. So we get a hot NFP number at the start of this month. Markets don't seem to worry about it. Things seem to suggest that perhaps we don't have the worst of all possible worlds developing just yet. There's a bit of relief in that maybe this hot number is not necessarily going to spur the Fed one way or another. But then a CPI number comes out, and despite the fact that it's an upside surprise that doesn't really speak to anything Fed relevant, it nevertheless is an upside surprise, narrow though it was. And the rally stops in its tracks. Subsequently, Fed Chair Powell speaks at the Economic Club of New York on the 19th of October and says, yeah, higher for longer is definitely on. We're probably not going to need to raise rates because what's happened since we told you that higher for longer is going to be the strategy in September, bond yields have moved to basically do the 50 basis points for us. And so maybe we don't need to necessarily adjust beyond that. Maybe that work is done. Maybe we've restricted borrowing conditions enough. You can see that here. So there's the September 20th FOMC, and you can see since then, higher for longer is on display in spades. The 2-year yield is idling, so no more rate hikes. That's the part of the yield curve that's relatively near term and much more sensitive to Fed policy odds, so no changes there. But then longer term, rates start to surge. So we can see that there's a widening gap here in between the 2-year and the 10-year, and we can see much of that gap is made up by a flip to positive territory on term premium in the Treasury market. That's the 10-year term premium in the yellow bars. Now, what does this mean? Essentially, it means the market wants extra compensation for lending over longer periods of time, implying it is more concerned about what happens with the passage of time and is viewing that passage as a risk unto itself. So more can go wrong than before. And that, of course, speaks to the added uncertainty that higher for longer brings. The market is basically saying, well, we don't know how much more economic pain is going to come because the Fed is delaying rate cuts, because the Fed is going to hold rates high, and how much of a squeeze this is going to end up looking like, how much worse of a recession this might amount to. And so we're going to need extra compensation. You're going to have to pay us more in interest to lend over a 10-year period versus a 2-year period. And the reason is we're less sure about what's coming next. We're less sure of the consequences of this decision, and we're worried. Now, you can see here, and we've taken the consideration for this meeting or that off the table here. The orange line is where the Fed funds rate is at any given moment on any given day, looking out 12 months. And you can see here that really since the middle of the year here, the 12-month outlook for interest rates hasn't really changed very much. So policy expectations have been basically at standstill, idling at about 5%, give or take. So this has been remarkably steady. The difference that occurs when the Fed unveils its higher for longer idea here in earnest is that financial stress in markets starts rising. And this is, of course, what the Fed is saying when they're saying, well, look, maybe the tightening that we've done is enough. And maybe what the markets have done since we said this in September gets us to where we want it to go. That would be the pickup in financial stress, this concern that borrowing costs are going to be more elevated. We can see the impact of that on stocks. They've moved right in tandem with what's going on with the pickup in financial stress, and of course have come down. So why is it then that this November policy announcement ought to be something we're concerned about if in fact we're in a situation where everything is done and perhaps there's nothing else down the line? Well, it's right there in the verbiage, higher for longer. The markets think that this means cuts by the rough middle of next year, sort of by July. But the Fed has not endorsed that timeline. And so here it becomes important to take a look at what it is that the Fed is looking at and what they might say to move the markets one way or another as we start to get a clearer picture on what their calculus is. Now, as ever, this is the latest update on what inflation looks like. We can see that core inflation, which is the part that the Fed really cares about, has been steadily declining. We can likewise see that at this point, goods inflation has been all but completely squeezed out. Food is holding up, but it's not a major contributor and has come in quite a bit. The key is still services. Energy is a negative contributor. It's actually pulling inflation lower, but because we've had a bit of a pop in crude oil in the past 2-3 months, the negative contribution has become small. In fact, that seems to generally account for what we see in headline inflation and core inflation diverging. So as you get less of a negative contribution from energy, headline inflation has also come up. That's the one that includes energy and food. But core inflation that excludes energy and food has continued to come down, right in line with this slow decline in services inflation. But needless to say, services is still by far the biggest contributor. So that's, of course, where the Fed is necessarily focused. Now, what is this made up of? Well, not surprisingly, this is overwhelmingly shelter, so the cost of housing. And the Fed can't really do much about that because much of the reason that this issue exists is the Fed's own doing. In raising interest rates as quickly as they have, what the Fed has done is made mortgage rates soar. But the picture as it is faced by existing borrowers, which tend to have locked in fixed rate 30-year mortgages, is much more digestible. So the average interest rate on outstanding mortgage debt is about 3.6%. The current mortgage debt that one could take out at these interest rates is closer to 8. And so the market is looking at about a 4% gap in between what one would be paying for an existing home that's already been financed and where that has been locked in, and where somebody would need to finance a new purchase were one to sell one's house and buy another. So not surprisingly, people are not exactly in a hurry to sell houses, which has essentially locked up the market, made it illiquid because nobody's selling. And since nobody is selling, the price isn't really going down. Ostensibly, when the Fed were to begin rate cuts, this could unlock. But if the Fed is concerned about inflation, well, then it's not going to do that in any kind of hurry, which leaves the rest of the service sector. And here, the main culprit, as the Fed has said time and time again, are labor markets. Because whereas markets for goods and even services tend to adjust to weaker economic demand and prices tend to come down, labor markets are sticky because wages don't tend to adjust lower for inflation. That they can sometimes adjust higher, but they don't generally adjust lower. What tends to happen is, to get wages to adjust lower, layoffs have to come. The picture looks sort of like this. We can see overall inflation has come down considerably. We're looking at a headline that's gone from 9% to about 4%, a core reading that has gone from near 7% to about 4%, but an employment cost index in the yellow there that has gone down by less than 1%. And much of that is the lingering mismatch post-COVID between labor supply and demand. We can see we're still looking at a deficit of close to 3 million workers. That's the blue bars there under zero. And of course, where that shortage was greatest, back half of 2021, first half of 2022, we were looking at about 6 million worker shortage. And like anything else, when there is a shortage relative to demand, those with money bid up the price. So companies went out and basically competed on the price of labor to get that scarce labor to come through their doors. And what that's meant is they've locked in wages at these high, elevated post-COVID levels. Now, what the Fed has been saying is that these wages need to be reset in order to get that inflation squeezed out of the labor market. And resetting wages is really just a more palatable way of saying layoffs. And so if the Fed were to come out here and say, well, we're not prepared to consider rate cuts until we get evidence, and the Fed has made this point clear, that the labor market is weakening, that the unemployment rate is going up, and that this process is starting to squeeze that sticky labor market inflation out of the system. And then later this week, we're expected to see that the unemployment rate held unchanged yet again at 3.8%, which is a hair above the historic low at 3.4, which we saw toward the end of last year. So far, labor markets have been reasonably resilient. If the message from the Fed then is, you're not getting a reprieve on rates until these numbers start going up, then higher for longer might end up looking meaningfully longer than what the markets have already priced in. And so the capacity for the Fed to spook investors here is still significant, because as long as we still get movement in the direction of delaying rate cuts, as long as that remains a possibility here, and the Fed really wouldn't need to change much of its rhetoric. All of this is consistent with what they've been saying. Then the markets may well still wobble. Now, the most interesting part of this is that, of course, at this stage, looking at the PMI data, we're already looking at global recession at our doorstep, because the slowdown that we've been seeing across markets is occurring everywhere. The story that you see painted on this chart here is much the same for developed markets, emerging markets, the US, Europe, Asia. And that is a coordinated decline from about mid-2021 to about the beginning of this year in manufacturing and service sector growth, with the end of 2022 giving us contraction across all levels. This is, of course, PMI data, so it operates on a logic where 50 is neutral, Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what we see here is at the end of last year, everything dips into contraction. And then at the start of the year, there's a pop in services. And of course, the service sector is the largest component of the economy, generally speaking, for almost all markets. And so what you then end up with is a situation where that starts to pull overall demand higher. Well, that has since fizzled. And so now when we're looking at the composite index here, bringing together manufacturing and services, we are at just 50.5. We're going to get the update for October numbers here in just a couple days by the end of the week. And the leading numbers we've looked at don't look encouraging. Chances are we get a further dip lower here. So there is a global recession that's almost certainly, or some kind of a global recession that's almost certainly underway. Big one, little one, more broad-based, less broad-based, that time will tell. But there is almost certainly some kind of an economic downturn on a global basis that is already underway. And even still, the degree of weakness seems to be less bad than markets anticipated. What we see here is Citigroup's Economic Surprise Index for the globe, for developed markets and emerging markets, developed in the orange, emerging in the red. And what we see here is from about the middle of the year, as you start to get this fizzling in growth and people start to expect that some kind of a downturn is coming, their expectations move lower, but they end up being too pessimistic relative to reality. In fact, increasingly too pessimistic. And so now we see that economic data coming out of really the full spectrum of the global economy is looking increasingly better than expected. Now, better than expected doesn't mean good, doesn't mean not weak, but it does mean better than expected. So less weak, less bad. And of course, as far as the markets are concerned, it is expectations that matter. Market volatility comes from outcomes being mismatched with expectations, and then people have to adjust portfolios accordingly. Markets don't necessarily fear bad outcomes. They fear unexpected outcomes. Because what they fear is being positioned wrongly for what actually occurs. So things are getting weak, in fact, quite a bit weak, but perhaps less weak than everybody feared. So the underlying environment might well favor a positive perspective, risk on. Markets might well be more concerned with looking at the global landscape and saying, okay, everybody is in a downturn, so there's not a whole lot of relative strength economy to economy. You can see that here. But things aren't as bad as they could be, or at least as bad as we thought. And so this perhaps is a time to start looking for pockets of strength and bargain hunting. Now, if everybody's in a coordinated downturn and most central banks, including the Fed, are calling an end to rate hikes as that occurs, defining where relative strength might be could be an exercise in essentially saying, well, which central bank is going to help its economy first? Which central bank is going to start to ease faster and provide more of a tailwind to recovery sooner versus elsewhere? And it is here that a Fed minded on raising the jobless rate as a prerequisite to rate cuts might well be a hindrance. It could certainly spook Wall Street, it could certainly spook broader global markets. But the underlying idea might well be, well, the headwind is going to be greatest for US dollar denominated assets because that's where the holdout on stimulus is. But other parts of the market, other geographies, other central banks might be sooner to ease. And so perhaps there is some bargain hunting to be had there. And indeed, we can see US markets have significantly outperformed their global peers this year. This is a range of ETFs looking at regional performance. So we can see emerging markets down 8% on the year, even as US markets are up almost 8%. UK down 3.8%, Eurozone down almost 2%, and the sort of broader catch-all Europe, Australasia, and the like, so East Asia and such, that is down about 1.8% as well. So what we're looking at here, especially when we consider Europe, where the ECB signaled that rate cuts were probably closer on the way last week, where we just got negative GDP data and indeed worse GDP data than expected overnight, lower inflation data than we expected overnight, we might have more scope for sooner stimulus and a bargain in relative terms to what is going on in the US. It's much the same for emerging markets, though there is perhaps less room for stimulus because they did less tightening to begin with. And so what we're looking at here is perhaps a reason why capital might move at the side of a more hawkish Fed out of US dollar denominated assets. So US stocks might suffer, but more broadly, US dollar denominated assets might be hurt. And those denominated in other currencies might benefit. And so not only might you get a pickup in European markets, but also the euro. Not only might you get a pickup in emerging market shares, but also the likes of the Aussie dollar, which tends to track those. And of course, we'll see what happens with the UK this week. They have their policy announcement, and they're expected to do much as the ECB has done last week and signal rate hikes have ended, and cuts are on the menu. So there could be a similar story there. So while the Fed might well spook US markets with a hawkish perspective, that this is something that typically would be supportive for the dollar, could be somewhat counterintuitively in reverse this time, where capital says, okay, stocks don't look great in the US, but maybe elsewhere where stimulus is more forthcoming and where that's going to happen sooner, stocks look more attractive, as do the underlying currencies. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we try to break down what happened on a given day after the Wall Street's close and try to figure out what might happen next. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at @iliaspback. Thanks very much for joining. We'll be back tomorrow. Till then, good luck trading out there. Take care.